Before we start, I would want you to hit that red subscribe button so that you never miss out on any of our videos. Hey guys, what's up? Welcome back to Business Hunters. Discrepancies and misuse of user funds. The empire constructed by Mr. Bankman Fried, who was once compared to financial heavyweights such as John Pierpont Morgan and Warren Buffett, collapsed last month when a run on deposits left his cryptocurrency exchange, FTX, with an $8 billion shortfall, forcing the company to declare bankruptcy. The impact has reverberated throughout the sector, upsetting other cryptocurrency firms and fostering broad mistrust in the technology. Mr. Bankman Fried has spoken publicly very little during the past week, excluding a few tweets, notes to staff, and sporadic texts to reporters. In a recent interview, he expressed various regrets over the demise of FTX. However, he would only provide little information regarding the fundamental questions surrounding him. Whether FTX inappropriately utilized billions of dollars in customer funds to prop up Alameda Research, a trading firm he had created. The Justice Department and the SEC are investigating this connection. Mr. Bankman Fried stated that Alameda had amassed a big margin positions on FTX, which essentially meant that the company had borrowed funds from the exchange. It was significantly greater than I had anticipated, he remarked. The magnitude of the stake was in the billions of dollars, he added, but he declined to disclose any information. However, Mr. Bankman Fried concurred with opponents in the crypto community who stated that he had grown his commercial activities too rapidly across vast portions of the market. He stated that his other obligations caused him to overlook warning signs that FTX was in trouble. Had I paid a little more attention to what I was doing, I could have been more thorough. That would have enabled me to recognize what was occurring on the danger side, he remarked. Concerns within the crypto community. FTX exchange was shocked the cryptocurrency community. According to reviews with 9 of Mr. Bankman Fried's co-worker and business partners, as well as integral messages obtained by the New York Times, warning indications had arisen in recent months that his economic empire was in jeopardy and that his ambitions exceeded his ability. Meanwhile, Mr. Bankman Fried declined to elaborate on his current whereabouts, citing safety concerns. Mr. Bankman Fried and FTX attorneys did not reply to calls for comments. However, as he began on a buying binge this year, investing in struggling Bitcoin firms, he withheld information from critical personnel. When he was informed that he was overworked and advised to hire extra personnel, he opposed the advice. And in Washington, he advocated for an aggressive regulatory agenda while criticizing Changpeng Zhao, the CEO of rival exchange Binance, who ultimately rallied his fast Twitter following to trigger the run on FTX. Despite the billions of dollars that venture capital companies invested in the company, none of these outside investors sat on the board of FTX. According to 4 people familiar with the situations, Mr. Bankman Fried maintained a secluded existence in the Bahamas, surrounded by a small group of co-workers, some of whom were in romantic relationships with other FTX employees. His top lieutenants, as he shared a penthouse at Albany, a 600-acre oceanfront resort on the Bahamas' New Providence Island. When asked if he was unduly dependent on this tiny group, Mr. Bankman Fried stated that he had roughly 15 close colleagues. I don't believe someone can sustain intimate contact and communications with more than 15 people, he stated. The FTX meltdown was inevitable. Mr. Bankman Fried's fall was precipitated by his association with Alameda and FTX. He established a trading firm in 2017 and rented offices in Berkeley, California, close to where he had grown up as the son of Stanford law professors. The company quickly amassed millions of dollars by exploiting Bitcoin market inefficiencies. In 2019, Mr. Bankman Fried transferred the business to Hong Kong, where the regulatory climate is more favorable. He subsequently founded FTX, a platform for crypto investors to purchase, sell, and hold digital assets, along with a small group of traders, including Caroline Ellison, a former trader at the financial firm Jane Street. FTX and Alameda were intimately connected. Alameda traded extensively on the FTX platform, which means that it occasionally gained the FTX other customers lost money, a situation that critics deem to be a conflict of interest. In the past, Mr. Bankman Fried has defended the arrangement by stating that Alameda supplied vital liquidity, financial injections that allowed other clients to execute trades on the crypto exchange. Ms. Ellison ran Alameda, but Mr. Bankman Fried was also active, participating in the decision-making process for major trades, according to a source familiar with the company's inner workings. At times, there appeared to be little separations between the firms. Alameda was meant to work out of a separate office, but a guest who visited FTX building during the past few months said that Ms. Ellison was seated in plain view of computers displaying the exchange trading data. In a court filing dated November 19, FTX enumerated the investors to whom it owes the most money. The exchange owes its top 50 creditors a total about $3.1 billion, with almost $1.45 billion owing to its top 10 debtor alone. CNN claims that the corporations may have over 1 million individual creditors and that it has been in touch with large numbers of international financial regulators. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the other 2 videos that are on your screen because I'm sure you will love them. With that, I'll see you in the next video.